Hi, and welcome to the Macro Show. We talk macro and trying to make sense of markets that, yeah, that's right, the kingdom defended itself today to sort of make sense. But the real question today is the stimulus package going to be stimulative? I'm your host, Steve Van Meter, and the answer is I really am not convinced that it's going to be that stimulus or inflationary or stimulative. I mean, got to consider it's half the size of the previous one for starters. And I think they're bringing the income threshold down a bit, which is fine because that's really the people who need the money. But when you kind of look at the bigger picture here, student loan repayments, they start back in January. They've been on hiatus for a while. They're coming back. In March, what do we have with people who are on forbearance on their government loans? It's the first month that payments resume. And what about evictions? Yeah, those are coming back. We know that's going to start. If it's not happening already, it's starting to happen. It will continue into next year. And all those things are going to create demand for money. You have to look back to where things were. When the first round of checks came out, the first $1,200 checks came out, people thought they were on extended vacation. So it wasn't a big deal then. Now it's pretty obvious. There are people who have lost their jobs that know their job is not coming back. And if it does, it's not coming back right away, and it may not have the same pay or the same hours. It's likely to be less. So now you have a whole group of the economy that really needs to focus or is focusing on feeding their family, trying to figure out where they're going to put a roof over their head because they haven't been making payments. They're not in a position to. So what's likely to happen with these checks? Well, will there be people that buy stocks? Sure. Maybe they'll buy Bitcoin or call options. Who knows? There will be people that really don't need this money that will take this as an opportunity to see if they can, get something more out of it. There will be other people who don't really need it either, and they'll use it to pay down debt because perhaps they're not as confident about the security of their job. And so they'll look to, or maybe it's their spouse or their overall household's income, and they'll look to retire debt. We've seen that before. And then there's a whole group of people, like I said, this will be going to feed their family, put warm clothes on their back, may pay the utility bills to keep the heat running. These are more critical people that need the money. And when you see money being directed into certain aspects of the economy, so say like food, you'll get food inflation, but you'll get disinflation or deflation on other sides of the economy where there isn't the demand. So from my view, especially considering you have these student loan payments coming back, and that's going to impact quite a few households, and not to mention the mortgage is coming out of forbearance. I could easily see a family say, hey, you know what, we haven't made our mortgage payment in almost a year, and it's starting up pretty soon. Well, we better hang on to this money just in case. So I don't think this is going to be quite as stimulative and inflationary as the market is billing. And of course, the bond market kind of showed us that today. All right, so on deck, we've got the auction data. The commitment traders report just came out. Another chart from our friend Stefan. I know many of you love that. H.8 report is out. We got the updated schedule on quantitative easing. I think we should take a look at some charts too, but let's jump right into the H.8. Now, this was delayed from Friday, and this is pretty interesting. Bank credit is up 36 billion, but most of that is due to securities in bank credit or bonds that most people think no one wants to buy, but the banks and the Fed are loading up on them, was up 24 billion, with mortgage-backed securities up 18 and U.S. Treasuries down 2. So you notice that the banks haven't been piling up on the U.S. Treasuries, probably because they're struggling to keep up with the combination of demand and the need to feed the Fed. Let's take a look at loans and leases at all commercial banks. If you imagine that, it's up $13 billion, which is pretty impressive. Commercial industrial lending is down, looks like about $10 billion. Residential real estate up a mere 4. Now this is interesting because we've been looking at residential real estate, and if you go back to November of 19, it was sitting at 2.285 trillion, and now it's at 2.243. So we're likely to see, when the Fed charts get updated, which I suspect will be later today, but pretty soon we're going to see residential real estate contract on a year-over-year basis. That has never happened inside a recession. It's only happened after recession. So that's pretty interesting to me. Commercial real estate loans down $1 billion. How about the consumer, right? I mean, because this is really, what we care about. What's going on with the consumer? Loans flat, no change. Credit cards, no change. Automobile loans up a little bit. Otherwise, no major change. What's going up at the banks? Yeah, cash assets are really going up quite a bit at the commercial bank. So on Wednesday, providing the Fred database gets the charts updated, we'll go through and take a look at how those are positioned. So now let's take a look at this great chart I got from our friend Stefan off of his Bloomberg terminal this weekend, and it's pretty cool. So what we can do is go back to 2009. And what I like is he likes to see he's a big picture guy. We're macro, we're big picture. And he gives us a lot of extra detail here. So you can see this is TLT, which is the largest traded long-term, long-duration U.S. Treasury ETF. And then he's got the dealer versus commercial position, dealer being in the green, dealer in blue. And then he's got dealer versus non-commercial or speculative. Speculative is going to be in orange here. So if you go back to, say, 2009, early 2010, you can see the dealers had built up a fairly substantial long position, even coming out of this peak here as they were long going into from 2008. And as those positions backed off, what happened? You get a rally. And as the speculators back off, you get a rally in the bond market. And it also didn't hurt that the dealers also started backing off on the shorts. Now, we talked about before, the dealers should be naturally short. It's very rare that you run into periods where the dealers are not short at a little level. And even in here, as you can see, they're pretty much almost not short at all. But normally that's their risk, is covering their downside after they buy at auction. And we can see there's periods where the dealers are short, or not dealers, but the commercial traders are short up here at the peak in 2016. And then as soon as that drops off, they're back long, briefly short, and then they pile up right here, which now sets the bottom in 2018. Speculators are going short. It looks like the largest short position, maybe, or close to the largest short position in history. And all of a sudden, bond prices take off, as we've seen, where the speculators remain short and building up these positions. So where we're at now is you have this massive commercial position, which is mainly the large commercial banks. You have a huge speculative position from the hedge funds. And all that tells you is the likely direction for bond prices is to go up. At some point, we will want to see, the long positions of commercials and the short positions of the speculators start to unwind. And we would love to see the dealers unwind some of their short positions to really pull this thing together. Now, here is the CFTC report from today. And what you see is on the bonds, the short positions are down 36,000. Now, 36,000 isn't huge, but it's a good move down. It's not a giant move, but it's still showing now the speculators are backing off their short positions. But yet, on the same time, you have the dealers had to pick up almost 24,000 contracts on the short side. So kind of balancing that out as we've seen the dealers back off a little bit, and all of a sudden, boom, looks like they got nervous last week. And here we have the ultra bonds. The speculators increased their short positions by 6,000 contracts. Dealers backed off their short positions by 3,000. And let's take a look at a few of these while we're here. The 2-year. We see speculators backed off, dealers added to their short positions. Looking at the 10-year, speculators backed off about 5,000 contracts. The dealers added 23,000, almost 24,000 short contracts. Pretty big. So you see the dealers all of a sudden, for whatever reason, maybe there was something going in the end of the year they were a little worried about. Not really sure what that is, but they added those positions, and it doesn't appear they needed them at all. Speculators then on the Ultra 10, down 6,000 contracts. Dealers down almost 6,000 contracts on the short side. How about the 5-year? Speculators down 5,000. And on the short side, dealers up 4,500 on the short side. So it's kind of interesting to see a kind of a switch, but as speculators back off, at the same time, the dealers, for some reason get a little nervous last week. Maybe it was because of the stimulus bill. I have no idea. But what is interesting to me is when we look at today's auctions, we've got the 2-year note and the 5-year, and they weren't anything spectacular other than direct bidders or domestic U.S. bidders bumped both of their bids up by about a couple billion, which is pretty unusual. And so we saw domestic bidders needing a little more demand, and that took some pressure off of the primary dealers, making this decent auction. Not substantial, not terrible, but the fact there's domestic interest is good. So now the big question is, did Fed Chair Powell give the bond kingdom a Christmas gift? Well, sort of. It's a little delayed. There will be no more QE for the remainder of this year. The next purchase schedule begins on January 4th, so we have no QE for Tuesday, Wednesday, or Thursday, but the schedule is just a repeat of what Powell has normally done. Now, is that a big deal? Not really, because we still have this quarter in rebalancing. Some people think, is that really legit? Look, if you manage asset allocation models and in your investment policy statement it says every quarter I will rebalance back to 60-40 or whatever the allocation needs to be, you got to do it. There's nothing short about missing that opportunity. I mean, if it's in the investment policy statement, you have to do it. And as a result, we saw some decent action in today's bond market with, again, the kingdom protecting its position, holding the wall. As we saw this morning, 30-year Treasury dipped a little over 1.7%. Now, 1.7 has been a very strong level. The kingdom has fought aggressively to defend that, and sure enough, it held. And in fact, all of quite a bit of a move was made today as bond prices initially dipped and then rallied all the way up. Now, what did look really good was the equity market as stocks continued to make big moves, big overnight gap up as investors are super bullish about the economy. But there's only one problem with that, is the economy is about 3 years plus behind where the stock market is at. In fact, the stock market is arguably pricing in where the stock market would be even a couple of years ahead had there not been a pandemic. So investors here are really looking for inflation, and the bond market, which again, everyone said, look, the stimulus is going to be inflationary. The bond market is telling you no. We're seeing momentum start to die down here and signal a bottom and a potential change. And we can see that in the price action. We're not seeing new lows. We're not seeing now a retest of this 6-month low. We're seeing some pretty decent demand here. It doesn't have to be on huge volume, but we're seeing decent demand. As a bit of a follow-up, from our piece on Sunday, large gold miners, GDX, went up, tagged the 50-day moving average. Remember, a rally starts with a cross and a decline starts with a cross below the 50-day and then tags it along the way. And sure enough, a rejection of the 50-day back below the 200-day. This is not a positive outlook, and I know a lot of people out there are really bullish on the miners. As you know, I am bearish on them because I'm bullish on the dollar due to QE. If you watch the QE special on Friday, and that tells me that the most likely direction here for GDX is actually lower. Let's take a look at the dollar while we're looking at this and see what happened. The dollar today got some legs too. It looks like it followed the bond market up and closed a bit higher on the day as well, with gold backing off a bit. It was, again, the GDX having the big down day, even relative to the juniors. But stocks were the big story. Everyone is bullish on the U.S. economy, and I am not overly sure how well that will work out for them, but they're going to give it their best. And I wish them luck because, again, you're talking a very speculative market, betting on all this money from the government being transferred into stocks, pushing them up higher. From part of the population, I mean, if you look at who's getting most of these checks, they don't own these stocks now. I mean, they own, I think, 0.6% of all equities. So the notion that they're going to come out and start running out and buy them when they got to feed their kids. As you know, I appreciate all of you being fans. Be sure to like, subscribe, backwards, forward, however that works. I don't know. But we'll be back on Wednesday, where we'll have probably some more economic data to look at. And I'll get the Fed charts updated because they're probably not out just yet. And we'll take a look at the year-over-year rate of change, where we're now looking at a contraction in credit, and that is not a good sign for the broad economy. I'm Steve Van Meter. Thanks for watching. Thanks for being fans. I'll see you on Wednesday. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. Material is not to be construed as a recommendation or solicitation to buy or sell a security, financial wrong instrument, or to participate in a particular trading strategy. This video was prepared by Steve Van Meter in personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steve Van Meter Financial.